Welcome to the Deep Dive. Today we're going straight to the heart of something many of us think about, financial freedom.
Yeah, it's a big one.
But, forget the images of yachts and endless vacations for just a second.
Right.
Our source for this, Peter A. Saul's audiobook, Financial Freedom, Achieve Financial Independence and Live on Your Own Terms. It paints a much more grounded picture.
It really does. It's more about control, isn't it? Having real options.
Exactly. Control over your life,
Yeah.
options in how you spend your time, your energy, and having the resources to build a life that reflects what truly matters to you, not just, what the paycheck dictates.
And the interesting thing is, it looks totally different for everyone. It's deeply personal.
So our mission here in this deep dive.
Well, it's basically to pull out the core ideas from Saul's work, the principles that can help you build that personal financial freedom.
Think of us as guides, maybe, highlighting the key insights, the practical steps.
Yeah, so you can get the essentials without feeling overwhelmed or getting bogged down in jargon.
Okay, so let's dive right in then. The audiobook starts with a really fundamental question, actually.
Which is?
What does financial freedom actually mean to you personally?
Right, not some abstract number.
Exactly. It's not just hitting like $1 million in your investment account. There's this story in the book about someone, Sarah.
Oh, yeah, I remember that one.
She was totally fixated on reaching $1 million net worth. That was her goal.
But then she dug deeper, right?
Yeah. And she realized what she really wanted was the freedom to leave this draining corporate job she had and just spend more time painting. That was her passion.
So the $1 million was just like a stand-in for the real goal.
Exactly. A proxy for that deeper desire.
That Sarah story is so telling. It really nails a key point the audiobook makes. Understanding your why.
Your motivation.
Yeah, the deep down reasons you're chasing financial freedom, that's the engine, that's what keeps you going.
The book even dips into some behavioral economics, suggesting that when your goals are tied to your core values,
They become way more powerful motivators. It connects your dreams to your daily actions. It makes it real.
and to make this concrete for you, the listener, there's this exercise in the book, My Financial Freedom Vision.
Sounds simple, but effective.
It is. Just take a few minutes, jot down maybe 3 to 5 specific things that achieving financial freedom would let you do or be or have.
No judgment, just what really excites you.
Right. Don't filter it, just
Yeah.
what gets you fired up. Keep that list somewhere visible. It's like your North Star for this whole journey.
Okay, got the vision. What's next? It's usually the less fun part, right?
Huh. Yeah, maybe. It's confronting your current financial reality, like stepping on the scales after the holidays, as you said.
You got to know where you're starting from to chart the course.
Exactly. The audiobook says you can't map your route if you don't know your starting point. And it boils down to understanding 2 key numbers.
Let me guess. Net worth and cash flow.
Bingo. Net worth and cash flow.
Okay, break down net worth first.
Sure. It's basically a snapshot, your personal balance sheet, if you will. It's what you own your assets minus what you owe your liabilities.
Right. Assets being cash, investments, house value, car value. Significant stuff you own.
Yeah, and liabilities are all your debts. Credit cards, student loans, car loans, mortgage, any personal loans you might have.
So the formula is simple. Total assets minus total liabilities equals net worth.
Simple math, yeah.
Yeah.
But the audiobook stresses this is just one data point, a picture of right now.
And the other piece, cash flow.
Right. Cash flow is about the movement of money in and out of your life, usually looked at month by month,
So money coming in, your income from all sources.
minus money going out, everything you spend money on.
And if more comes in than goes out, that's positive cash flow, a surplus.
Yep. And if you spend more than you earn, negative cash flow, a deficit.
Understanding that flow is crucial, right? It shows what you actually have available to work with, or where the leaks are.
Exactly. So the action steps here, according to the book, are pretty direct.
Let's hear 'em.
First, actually calculate your current net worth. List out all the assets, list out all the liabilities, do the subtraction, get that number.
Okay, face the music.
And second, just for 1 week, the book says it doesn't have to be forever, just a week. Track every single dollar you spend and every dollar you earn. Write it down, use an app, whatever works.
Get a real picture of where it's all going.
Yeah. And again, the point isn't judgment. It's just about clarity, knowing your starting point.
Okay, clarity achieved. We know where we are. We know where we want to go, roughly. What's the bridge?
The bridge is figuring out the how. And that leads us straight into budgeting.
Oh.
But wait.
Oh. The dreaded B word.
Right. Yeah, but the audiobook makes a really smart point here. Reframe it. Don't think budget. Think spending plan.
Ooh, I like that. Less about restriction, more about direction.
Precisely. It's
Yeah.
not about deprivation. It's about intentionally directing your money towards the things that actually matter to you, things that align with your vision, your values.
That reframe is powerful, like giving your money a job to do.
Yeah. Or the book uses the analogy of a roadmap for your money, or like a business allocating its capital. Your income is your capital.
And your spending plan is how you invest it in your life. Makes sense. Are there different ways to do this spending plan thing?
Oh yeah, loads. The book touches on a few common ones. The key, it says, is finding one you'll actually stick with.
Consistency is king.
Totally. So there's the zero-based budget, very detailed.
That's where every single dollar gets assigned a job, right? Income minus all spending, saving, debt equals 0.
Exactly, high control. Then there's the 50-30-20 guideline. More flexible.
Roughly 50% on needs, 30% on wants, 20% on savings and debt. After tax.
That's the one. And then there's pay yourself first.
My personal favorite. Prioritize saving automatically.
Right. You decide how much to save, automate the transfer right when you get paid, before you spend on other stuff.
The underlying principle for all of them, though,
Is intentionality. Consciously deciding where the money goes instead of wondering where it all went at the end of the month.
so the action step. Pick one and try it.
Pretty much. Choose one method that feels right for you. And start simple. Don't try to perfect it overnight.
Maybe just track spending categories for a month or automate a small savings amount.
Exactly. Just take that first step. Build the habit of conscious spending.
Okay, conscious spending plan in place, or at least started. What about existing debt? That can feel like a huge roadblock.
Oh, absolutely. The audiobook really acknowledges that feeling, that weight of debt, the stress, how it limits your freedom.
But it offers hope, too, right? A path out.
Definitely. It starts by distinguishing between, let's say, good debt and bad debt.
Like a mortgage on an appreciating asset versus high-interest credit cards.
Precisely. The focus here is really on tackling that bad debt, the high-interest stuff used for consumption.
And how do you tackle it if you have multiple debts?
The book outlines the two main popular strategies, debt snowball and debt avalanche.
Okay, let's hear the difference. Snowball first.
Debt snowball. List your debt's smallest balance to largest. Ignore interest rates for a moment. Pay minimums on everything except the smallest. Throw every extra penny at that smallest one.
Okay.
Once it's gone, you take all the money you were paying on it, minimum plus extra, and add it to the minimum payment of the next smallest debt.
Ah, so the payment amount snowballs and gets bigger as you knock off debts. Creates momentum.
Exactly. Quick wins, psychological boost.
Got it. And the avalanche.
Debt avalanche. List debts by interest rate, highest to lowest, ignore the balance size. Pay minimums on all except the highest interest one. All extra money goes there.
And once that's paid off,
You take that full payment amount and attack the debt with the next highest interest rate, and so on.
mathematically this saves more money on interest over time.
Correct. It's technically more efficient financially.
But the book makes a key point here.
Yes. It says the better method isn't necessarily the mathematically optimal one. It's the one you will actually stick with.
Because consistency beats perfection. If the snowball's quick wins keep you motivated, that might be better for you.
Exactly. So the crucial action step, list all your debts. Creditor, balance, minimum payment, interest rate, everything.
Get it all down on paper or a spreadsheet.
Then choose snowball or avalanche.
Yeah.
Which one feels right for your personality? And then this is key, figure out how much extra you can realistically put towards that target debt this month,
Even if it's small.
even if it's small. And make that first extra payment. That first step gives you a huge sense of control. Momentum builds from there.
Okay, spending plan initiated, debt attack plan chosen. What about building some positive momentum? Savings.
Yes, building that crucial financial safety net, the emergency fund.
The buffer against life's curveballs.
Exactly. The audiobook is clear. This isn't savings for a vacation or a down payment. It's specifically for the unexpected. Job loss, medical bill, car breakdown.
Stuff that could derail your progress or force you back into debt if you're not prepared.
Right. Its whole purpose is to protect your progress and keep you out of debt when emergencies hit.
So how much should be in there? The standard advice is.
Typically 3 to 6 months worth of essential living expenses.
And essential means.
The absolute must-haves: housing, utilities, food, basic transportation, insurance, minimum debt payments, not wants, not discretionary stuff.
That 3 to 6 month number can sound huge, though. Intimidating.
Totally. The book acknowledges that and says, look, don't get overwhelmed. Even starting with a smaller goal, like $500 or $1,000 makes a huge difference. It gives you breathing room.
Provides that initial layer of security.
Exactly. And where do you keep this magic fund?
Definitely not in your regular checking account.
Right. Too easy to accidentally spend it. Keep it separate, safe, and easily accessible. A high-yield savings account is ideal. FDIC insured, of course, in the U.S.
Separate account. Safe, accessible. Got it. And how to build it consistently.
Automation is your friend here. Set up an automatic transfer from checking to your emergency fund savings. Every payday, maybe, or every week.
Even small amounts add up over time.
They really do.
Yeah.
So the action step for the emergency fund. First, calculate your target. What's 3 months of your essentials? What's 6 months? Know the goal.
Okay.
Second, if you don't have one, open that separate high-yield savings account. Label it clearly.
Emergency fund do not touch. Something like that?
Yeah. Wherever works. And third, set up that automatic transfer. Start with an amount that feels manageable now. You can always increase it later.
Build the habit first.
Exactly.
Okay, these are all really practical, concrete steps. Budgeting, debt, saving. But there's more to it, isn't there? The mental side.
Absolutely. The audiobook transitions really nicely here into the less tangible but maybe equally important aspect.
Yeah.
Mindset. Financial psychology.
The internal stuff that drives our decisions.
Yeah. It explains that our money decisions aren't always rational, are they? They're heavily influenced by emotions, past experiences, how we were raised.
Those money scripts we inherit or develop.
Right. And subconscious beliefs about wealth, scarcity, what we deserve, all that stuff.
It touches on behavioral economics again, right? Cognitive biases.
It does. Things like loss aversion.
Where losing $100 feels way worse than gaining $100 feels good.
Exactly. Which can make us overly cautious with investing, or panic and sell when the market dips, even if logically we know we should stay the course.
Or herd mentality, doing what everyone else is doing.
Yeah, that's another big one. Jumping on investment bandwagons because of FOMO, often when prices are already high.
Or panic selling when everyone else seems to be selling, usually at the bottom.
Yeah.
Buying high, selling low. The classic mistake.
The opposite of what you want to do.
So what's the takeaway here? How do we combat these biases?
Awareness is the first huge step. Just knowing these biases exist helps a lot.
Lets you pause and question your impulses.
Right. You can ask yourself, am I feeling this way because of the actual situation, or is loss aversion kicking in? Am I just following the crowd?
So the action step isn't calculation, it's reflection.
Exactly. The book suggests taking some time to identify one specific financial fear you have, or maybe a limiting belief about money. Where did it come from?
Dig into the origin story of that belief.
Yeah, just thinking about it, maybe writing it down. Understanding the roots can really lessen its power over your current behavior. It's empowering.
Okay, mind stuff acknowledged. Now let's talk about actually growing the money. Investing.
Right, putting our money to work for us. The audiobook defines investing pretty simply. Using your money to buy assets
Things like stocks, bonds, real estate.
that have the potential to grow in value over time or generate income, or both.
And it contrasts this with saving, right?
Yeah. Saving is crucial for safety, short-term goals, emergencies. But it usually doesn't grow much, often less than inflation over the long haul.
The book has an analogy for this too, doesn't it?
It does. Saving is like storing seeds safely in a jar. Investing is like planting those seeds in good soil, expecting them to grow into something much bigger.
Nice. But planting involves risk, right? The seeds might not sprout, or a storm could come.
Absolutely. Investing involves risk. The value can go down. But generally, the potential for higher long-term returns comes with taking on more risk, more volatility.
Stocks typically have higher growth potential, but more ups and downs than bonds, for example.
Right. The key message, though, is that for real long-term growth, beating inflation, you generally need to embrace some calculated investment risk.
And it's a long game, not get rich quick.
Definitely not. Patience is key. Which leads perfectly into the next concept.
The magic of compounding, the eighth wonder of the world.
That's the one, compound interest, or compound returns, really. It's earning returns on your returns.
So your money starts making money, and then that money starts making more money.
Exactly. Simple example. $1,000 invested, earns 10%. Year one, you have $1,100. Year two, you earn 10% not just on the original $1,000, but on the $1,100.
So you earn $110, now you have $1,210.
Right. And year three, you earn 10% on $1,210. It starts slow, but it accelerates.
Like that snowball rolling downhill analogy, gets bigger, faster, and faster.
That's it. And the most crucial ingredient for compounding.
Time. Absolutely time.
Starting early. even with small amounts, is way more powerful than starting big later on. Time lets the snowball really grow.
So the action step is about visualizing this power.
Yeah. The book suggests finding an online compound interest calculator. Lots of free ones out there.
Pull in some numbers.
Yep. An initial amount, maybe a monthly contribution you think you could manage, and an estimated average return, say 7 or 8% for long-term stock market averages.
And then see the projection over decades.
Yeah. Look at 10, 20, 30, even 40 years. Seeing how that growth curve steepens over time, it can be a real eye-opener, a huge motivator to just start.
Okay, convinced. Compounding is amazing. Start early. But what do we invest in? Stocks, bonds, funds. It can seem confusing.
It can. The audiobook breaks down the main building blocks simply. First, stocks.
Owning a piece of a company, like Apple or Amazon or whoever.
Exactly. Buy a share, you own a tiny fraction of that business. You make money if the stock price goes up, capital appreciation.
Or if the company pays out dividends, a share of the profit.
Right. Historically, highest growth potential, but also more volatile. More ups and downs in price.
Okay, stocks. What about bonds?
Bonds are basically loans. You lend money to a government or a corporation.
Like an IOU.
Pretty much. They promise to pay you back the original amount, the principal, on a set date, and usually pay you regular interest payments along the way.
Generally considered safer, more stable than stocks, but lower growth potential.
That's the typical trade-off. Income and stability versus growth potential.
And then funds, mutual funds, ETFs.
Right. These are pools of money from many investors, all bundled together to buy a whole collection of stocks or bonds or both or other things.
The pre-made fruit basket analogy you mentioned earlier, instant diversification.
Exactly. Instead of buying one apple and one orange, you buy the basket with lots of different fruits. Spreads the risk.
And the returns depend on what's in the basket.
Right. The risk and return profile depends on the fund's underlying holdings.
So for beginners, where does the book steer us? Individual stocks, bonds, funds.
For beginners, the strong recommendation is towards certain types of funds, specifically index funds and ETFs.
Why those?
Simplicity, low cost, effectiveness, and diversification. Remember, don't put all your eggs in one basket. Funds do that automatically.
And index funds, they track a market index, right? Like the S&P 500.
Exactly. An S&P 500 index fund just aims to hold the stocks of those 500 large U.S. companies in the same proportion as the index itself. It mimics the market performance.
Buying the whole haystack cheaply.
That's a great way to put it. And the cheaply part is crucial. Index funds usually have very low fees called expense ratios.
Because they're passively managed. No expensive fund manager trying to pick winners.
Right. They just follow the index recipe. And low fees make a huge difference to your returns over decades.
Okay, and ETFs, exchange-traded funds, similar benefits.
Very similar. ETFs also offer diversification, often track indexes, and usually have low fees. The main difference is how they trade.
ETFs trade like stocks throughout the day. Mutual funds price once a day.
Correct. But for a long-term buy-and-hold investor, that trading difference is often minor. The low cost and diversification are the key attractions for both.
And the book emphasizes why these are recommended over actively managed funds.
Yes, strongly. Because study after study shows most active managers fail to consistently beat their benchmark index after you account for their higher fees.
So by just buying the index cheaply, you'll likely outperform most of the pros over the long run.
Statistically, yes, it's a surprisingly effective strategy.
So action step, research one of these.
Yeah. Pick a broad market index fund or ETF, maybe S&P 500, total U.S. market, or total world market. Understand what index it tracks, check its diversification, how many holdings, and look for that super low expense ratio.
Aiming for it.
Ideally below 0.20% per year. Even lower is better.
Got it. Okay, we have the building blocks, stocks, bonds, low-cost funds. How do we put them together? Mix and match.
That's the next crucial step. Asset allocation.
Deciding the percentages. How much in stocks versus bonds?
Exactly. What percentage of your total investment portfolio goes into growth-focused assets, mainly stocks, versus stability-focused assets, mainly bonds?
And this decision is important.
The book argues it's probably the most important investment decision you'll make. More impactful on your long-term results and risk level than picking individual winners.
Wow. Okay. So how do you decide on the right mix? Is there a formula?
Not a perfect one-size-fits-all formula, no. It has to be personalized, based mainly on two things.
Time horizon and risk tolerance.
You got it. How long until you need the money? And how much stomach do you have for seeing your account balance go up and down in the short term?
Longer time horizon means you can generally afford to take more risk with stocks for higher potential growth.
Right. You have more time to recover from downturns. Shorter time horizon, needing the money soon, means you probably want more stability from bonds.
And risk tolerance is just how comfortable you are with volatility.
Yeah. Can you sleep at night if the market drops 10%? Or does that make you want to panic sell? Honesty with yourself here is key.
The book had an analogy for this too, adjusting sails on a boat.
That's right. Your goal is the destination, market volatility is the weather, time horizon is the length of the journey. You adjust your sails, your stock bond allocation accordingly.
What about those rules of thumb, like 110 minus your age for stock percentage?
The book mentions them as maybe a starting point for thinking, but stresses they're too simplistic. Your personal time horizon and risk tolerance are much more important than just your age.
So the action step is to think deeply about those personal factors.
Yes. Consider your age, your specific goals when you need the money, your overall time horizon, and your gut-level comfort with risk. Then draft a target allocation.
Like, okay, based on my factors, maybe 70% stocks, 30% bonds feels right for me.
Exactly. The book might provide some sample allocations based on different profiles in its resources, which can be helpful guides.
Okay, strategy set, allocation decided. Now, how do we actually do it consistently? Life gets busy.
The final piece of the puzzle, according to the audiobook. Automation.
Set it and forget it.
Pretty much. Using automation is one of the most powerful ways to build wealth consistently without needing constant willpower or attention.
Makes sense. Successful investors often just have a plan and let it run, right?
Exactly.
Yeah.
Automation makes that easy. It builds discipline, takes emotion out of the equation.
And lets you use dollar cost averaging.
Yes, we touched on that. Investing a fixed amount regularly, automatically, buys more shares when prices are low, fewer when high, smooths out your purchase price.
Takes away the temptation to try and time the market, which is usually futile.
Right. So practically, how do you automate?
Set up automatic transfers from your bank account to your investment account.
Yep. Straight into your IRA or brokerage account, investing in those chosen index funds or ETFs according to your target allocation. Ideally, time it for right after you get paid.
Before you even miss the money.
That's the idea. The benefits are huge. Discipline, less emotional decision-making, dollar cost averaging makes growth feel almost effortless over time.
So the final action step is just do it.
Basically, set up those automatic monthly investments, link your bank account, choose your funds based on your allocation, decide on the amount, and schedule the transfer.
If you haven't opened an investment account yet, that's step one, obviously.
And start with an amount that feels comfortable now. You can always adjust it up later as your income grows or your confidence builds.
Powerful stuff. Automation really ties it all together.
It really does. So wrapping up this deep dive, drawing from Peter Saul's audiobook, the core message seems to be,
It's achievable, right? Financial freedom isn't some impossible dream. It takes understanding, consistent action.
patience and keeping that long-term view.
Yeah. It's about empowerment, ultimately, taking control.
Giving yourself the resources and the freedom to design a life that actually aligns with your values, your real aspirations, not just chasing a paycheck.
So what's the crucial next step for someone listening?
Reflect, maybe. Which parts of this really clicked for you? Revisit those ideas, maybe check out the audiobook itself or related resources. Keep learning.
But most importantly,
Take action. Pick just one thing, one small, manageable step you can take today based on what we've discussed.
calculate net worth. Track spending for a week. Choose a debt strategy. Open that savings account. Set up a small automatic investment.
Any of those, just start. Because every step builds momentum.
And every conscious financial decision reinforces that path to freedom.
Absolutely. It strengthens the journey towards living life truly on your own terms.
So the final word.
Take that first step. Do it with confidence. Your journey starts now.